What's up, everyone? It's Scotty with MoneyVest. So in this video, we are going to be talking about Tesla stock, and Tesla here dropping over 15% in the last week alone on the back of earnings. And I specifically did a video going over here's the big problem that I would highly recommend you guys check out if you haven't already. And this video came out 7 days ago, so exactly about a week ago, I did that video before the numbers even came out, right? So 7 days ago, literally last Sunday, talked about how Tesla stock, here's the big problem. And of course, the thumbnail title was Short Tesla. Only because, look, there's been issues with prices and issues with macroeconomic environment with respect to interest rates. And that's really what's hurting Tesla stock right now, which is what we're going to discuss in this video, okay? Hope you guys enjoy it and find it helpful. Again, as I've mentioned before, I like Tesla, right? So I think it's got a lot of potential. So I'm not bashing on Tesla in this video, even though I personally own it. So I want to be as objective and unbiased as possible and try to keep everything sort of, basically my own biases, I'll keep them at bay. And the idea is for us to look at the actual reality of the situation. Only then we can kind of figure out what the problems are. Otherwise, if you're just blindly bullish or bearish on a company, on a stock or ETF or index, we're not going to get anywhere, right? We're not going to be getting anywhere if we don't actually poke holes in our own analysis. So hope you guys enjoy it. And again, links to our Discord, Patreon is going to be down below. We'd love to have you on board. You can access the early access to our beta launch, which happens in February of 2024. So you can get early access on moneyvest.com. You can go there. And you also do get access to our Excel spreadsheet. So this right here is our MoneyVest fair value sort of watch list, where we have created this entire spreadsheet where you can access and view all the stocks and including our fair value. So there's going to be a section for MoneyVest intrinsic values, and that will tell you how much of a difference there needs to be in order for these stocks to come down to the intrinsic value that I've calculated. And this right here is going to be the entire estimates, 5-year CAGRs, net income, PEG ratio, share dilution, discount rate, margin of safety, and we've got a section to highlight some risks for each company as well. So all that's going to be included with the link down below, and we'd love to have you on board. I think this is very, very valuable, insightful information, and this is eventually going to get switched over to the platform, right? So it's going to be available on moneyvest.com as well. So headline, the stock ends the week down 15%, the worst performance of the year. So Tesla shares dropped more than 15% over the last few days to close the week at $211, $212. I think there is a possibility that we end up, even lower. I think low 200s is a possibility for Tesla that I think everyone should be prepared for. And in this video, right, the main sort of things that we highlighted were the idea that interest rates are going to play a bigger and bigger role for Tesla's fundamentals, right? Because right now, with so many price cuts Tesla is doing, right, the price cuts, the aggressiveness or the rate of these price cuts is happening at a faster rate than the rate of these cost reductions that Tesla is witnessing or experiencing, right? In other words, yes, the cost is coming down. Yes, the cost of producing each electric vehicle is also coming down. But the rate of these price cuts is more than the rate of these cost cuts. In other words, Tesla might be cutting prices by 20% and might only witness a cost reduction of 10%, right? So that additional 10% that they're cutting prices by is squeezing the margins out. And that's happened in 5 to 6 quarters in a row. I mean, gross margins have gone from 25, 26% down to now under 18%, right? So we've seen a good 7%, or in other words, 700 basis points margin compression that has happened over the last 5 quarters. Same thing with operating margins, right? Operating margins ended up at 7.6, right? I mean, that has come down 1,000 basis points, right? I mean, that's come from like 16, 17% to now sitting at 7.6. So a full 10 percentage point margin compression that's happening on the operating side. So this is purely macroeconomical, right? I mean, if yields were not as high as they are, and we talked about the auto loans in that video that you can go ahead and watch. So this right here, definitely do check that out from a week ago. I mentioned that there is possibility that Tesla's showing signs of weakness. We might break down below 240s and 230s and might end up in the low 200s, and that's really where we are. And I do still think we'll get to the technicals in just a minute, but I do still think that there is more possibility that Tesla sees more downside, considering that the valuation remains a little bit higher. And look, we already knew from the delivery numbers right from the get-go that 435,000, which was again a miss from 460s, a 25,000 car vehicle delivery miss, was going to affect Tesla's earnings by 8 cents per share. And guess what? They reported 66 cents off of 73. So we were off by 1 cent, right? So basically they missed earnings expectations by 7 cents, right? And that makes sense because they missed deliveries by 25,000. So when they missed deliveries by 25,000, that translates to a 8-cent earnings miss on the bottom line, which ended up at around 7 cents. So we were off by 1 cent, as I said earlier, and the revenues also came somewhat in line, a little bit lower than what the expectations were. But this is the real problem, right? This right here is the biggest problem for Tesla and for Enphase. I don't want to club Enphase in this video, but still want to kind of mention that this is the biggest issue right now for consumers. Now, I think the analysis that consumers need to make is that over the long term, even if they do finance a new purchase of an electric vehicle, is that going to be saving them money over the cost of gasoline, right? If they're paying more in gas prices, in petrol, in oil prices, since they are pretty elevated still, is that going to justify them buying an electric vehicle where they can pay for electricity, which is going to be lower compared to what they pay for a gas-powered vehicle? Apparently not, right? So Tesla still needs to lower prices to make it more affordable for folks so that they can actually purchase Tesla vehicles and continue to increase demand. With 1.8 million vehicle deliveries that Tesla has for this year, I think that's okay, but that's going to come at the expense of price cuts. I wouldn't be surprised if Tesla does a few more price cuts before the year closes out to hit those delivery volumes of 1.8 million that they have suggested. But unfortunately, if that's coming at the expense of margins, that is not the strategy that, I would have employed, right? Of course, I'm not running Tesla or whatever, but it's just, it's one of those things where it is hurting the company's profitability. And look, long-term, people would argue that it's not just a car company, okay? But here's the problem. Your thesis should not depend on the potential for Tesla to execute at its best and become a tech company. If you are investing in the company, right, Tesla, for example, and your entire thesis depends on this concept that Tesla is going to become a tech company, then I think, in my opinion at least, it's going to lead to somewhat of a conflict with your own thesis in the future if Tesla doesn't achieve anything close to what you imagined. What we have to look at it is, where's the revenue coming from, right, today, in the present, right? Where's the revenue coming from? And 95% of it is electric vehicles. And that's why right now, believe it or not, I still consider Tesla as an electric vehicle company, right? That's why my fair value is at 150. That's why my intrinsic value in Tesla, you can come back. I don't know if it's going to be there on the screenshot here, but let's see where we are. I think it's close to 150 or 170 in and around those levels. But let's take a look at where we are. Okay, so Tesla right here. And again, you can access all these with our Money Vest community, right? You can go down and check those out. Tesla right here, right? This is Tesla. You go across, and we're looking at 136, right? So 136, it closed at $211.99. So that's the $211. 136 is my fair value. That means 35% more downside needed for Tesla to be trading at its intrinsic value, right? Just want to make sure that that is indeed correct. So 211 to 136, we're looking at 36. Yeah, so close to 36, 37% potential downside needed in order for Tesla to be trading at its intrinsic value based on our calculation, based on my calculation, basically. And that's the whole idea, right? For me, the electric vehicle, the full self-driving, right? The autonomous driving, the AI component, the supercomputers, the dojo, right? The solar, the battery, everything's kind of like a cherry on top. It's like the icing on the cake. It's not the cake itself. It's the icing on the cake, right? If it happens, great, right? That's going to increase the potential for Tesla in revenues and whatnot. But that is not the main thesis, right? Main thesis is, can Tesla deliver electric vehicles, high quality electric vehicles, and go through this energy transition and do them at size and scale while also maintaining margins, right? If Tesla's having to constantly reduce prices at the expense of lowering margins, I'm not sure how Tesla's future is going to shape out, right, in terms of its forecast. Look, I'm still bullish, I'm still a holder, but we have to kind of constantly be on top of what's going on with price cuts and margins, because if that continue to compress, well, that's going to lower earnings expectations for the company, right? So right now, the EPS expectations for 2023 is already a decline from $4, right? $4.07 down to $3.14, right? So if you do the math now at 212, we're looking at a price earnings multiple of 67, right? So already, once again, we're pushing back higher. We came down to, 33 towards the fourth quarter of 22 because we went into this year 2023 with very solid expectations of, earnings and margins, and everything was like, sky high going into this year. But since then, Tesla's had significant amount of price cuts, several price cuts along the way, and that has lowered the margins, which has lowered the earnings, and that's once again increased the price to earnings multiple back up to over 60 and 70. So, that's what happens when margins compress and earnings, come down. Price earnings valuation multiples once again start to become very, very overexpensive, and a level where, originally we never thought that Tesla could get up to, right? We were looking at 30 just a few months ago. Now it's back up to over 60 and 70. So, looking at the technicals, I'm still watching for Tesla levels close to here. I think low 200s is still a possibility, kind of in line with this previous resistance and that support level to watch for Tesla. But like I said, look, I am optimistic about Tesla's execution strategy, but they are doing a lot at the same time. So I think Elon Musk really needs to focus on what is the essential, what is the more important thing and projects to focus on. But long term, like I said, everything else, right? AI, FSD, solar battery, that's like the icing on cake, the main cake, right? Look at Apple. Apple has a 1.2 billion install base for iPhones, right? It is now, after 12, 15 years of consistently selling hundreds of millions of phones every single year, that they've gotten to a point where they can maybe start relying on services, right? Even then, 20% of the revenue is services. That's updated from 10% from 10 years ago. But even right now, they can't rely on services, right? Yes, they deserve a higher multiple because of services, but even right now, the revenues, the main driver is still the iPhone. So for Tesla, the main driver will always be electric vehicles. That is the main business. I think everyone needs to get it through their head. The main business is electric vehicles. Everything's built on top of that. The entire ecosystem is built on top of EVs. Okay, so that's where we are. And hope you guys enjoy this video. Let me know your thoughts down in the comment section below. Like I said, 150s, 130s basically where my fair value ends up. As you can see in this chart, again, this is going to be available for all the members. If you want to get access, link's going to be down below. There's going to be a lot of stocks that start hitting their fair values, right? Some of them are already undervalued in my opinion based on these spreadsheets. But there's going to be more, right? There's going to be more. Like for example, this one's only 11% away. And we're going to be updating this with more and more stocks, right? There's going to be a whole database and a whole library of like 200, 300, 400, 500 stocks. They're going to be constantly updated regularly for you to access and view and kind of create your own shopping list from this. So link's going to be down below. We'd love to have you on board. And as always, make sure that you drop a like, subscribe to the channel. Happy investing. I'll see you all in the next video.